Hi, everybody. It's Jessica Stone at Stansberry Research, and I'm joined by Vic Lederman, the senior analyst for True Wealth. And Vic, I wanted to ask you, we're seeing so much technology make it easier for novice investors to get into the marketplace. I've done interviews about Robinhood, and there's obviously a lot of interest in what's going on in the markets. There's certainly gamblers and people that are normally sports bettors that are just bereft of something to do. So they're getting into the markets. But one thing that really puzzles me is we've seen them get into a series of stocks that are they're going bankrupt. I mean, Hertz, J.C. Penney, there's been energy stocks. People are literally buying them after they file Chapter 11 bankruptcy. What the heck is going on?
Yeah, it's something, I wish that I could say that it shocked me. I've seen a lot of harrowing stories since I started working in the world of finance, but this is just truly stunning. And I think what's going on is there are people that are buying companies that are either teetering on the edge of bankruptcy or really kind of in the process of starting to go bankrupt. And they're thinking that they're actually going to make money on these trades. They think that their shares are going to get bought out by another company. Specifically, you mentioned J.C. Penney and Hertz. Those are companies that have been around for ages, and people think of them as these big pieces of society. There's no way that they're going to go out of business, right?
Yeah, I don't know about you, but I think I had some memorable shopping experiences as a kid at J.C. Penney, getting my clothes.
Absolutely. Yeah, so I think when people buy these, they really believe that the shareholders are going to be made whole in these bankruptcy filings. And that's just, the finance way of saying that they're going to make some money on the way out. That's just not how it works, unfortunately.
They're obviously mistaken, but what are they making the main mistake about in terms of their understanding of the process?
Yeah, it's what we call the capital structure. And basically that's the order of who gets paid and in what order. And most people don't realize this, but when you buy shares of a company, you're actually pretty low down the totem pole when it comes to that. So generally speaking, bondholders and creditors get paid first. And usually they take what we call as a haircut. They don't get paid in full. So that leaves absolutely nothing left for the shareholders when a company goes under. And that's why these investors thinking that they're, making a winning trade are actually just going to lose all of their money.
Yeah, and I think they get a little bit encouraged too, right? Because the more of these novice investors flood into that stock, it actually does go up. But what they're missing is they're not going to get a piece of that going up. They're still going to be last in line to get paid. If they were more sophisticated, is there something they could be doing? We've talked about puts and options, and there are different strategies to protect yourself as an investor. What is one way they could be more sophisticated and still make that trade?
Let me put up a chart here. What we're looking at is Hertz. And that's the company that, like we both said, nobody should have been playing with. But if you had to, let's say you had perfect foresight, you could have used what's called a trailing stop to help you get in and out of the trade. So let's say you picked the perfect day right before that stock exploded. Using a 20% trailing stop would have let you actually capture a lot of those gains, assuming that you'd been able to get in and out of the trade. Now, I'm really seriously not recommending that people do this, but you need to know when to be able to walk away. And a trailing stop is a great way to figure that out. It's something that we've written about in Daily Wealth a lot, and it's something that I really encourage mom and pop investors to check out.
Could you take us through the mechanics of that a little bit? If I am a retail investor, and most of our audience is, I have my account, how do I actually set that up, that trade?
The way that it works is most people are familiar with a stop price. That's when you buy an asset, you have a bottom floor where you're like, I'm getting out if it falls below that. Those are nice, but they don't prevent you, they don't allow you to lock in your gains. And that's really what this is all about, right? We want to make money on our trades. We don't want to just ride them up and down and, get out when they get back to zero. So a trailing stop is a percentage-based stop price that follows with the price of the asset. So let's say the asset goes from $100 to $200 and falls back down. The trailing stop will get you out at your fixed percentage on the way back down rather than letting you ride it all the way back to zero. It's a great way for average investors and really all kinds of investors to know when to walk away.
All right. Well, some good advice and education about what a trailing stop is and how it might have made a difference for these investors in Hertz and in JCPenney. Or thanks to you, Vic Lederman. For those of you who want to see more research by Vic, you can hover over the upper part of your screen and get a link to subscribe to any of the True Wealth products that he participates in. And you can also, of course, we recommend that you subscribe to our YouTube channel and follow us on Facebook, Instagram, LinkedIn, and Twitter. That's all for now. Thanks for joining us.